Hello everyone, welcome back to Investing with Aaron channel. This is the first time I'm outside my studio and I'm exploring one of the most prominent malls in Malaysia, which is known as the Curve Malaysia. The reason why I'm outside in the Curve Malaysia is I'm trying to explore one of the retail outlets and see whether if the coronavirus did impact on the retail sector as a whole based on the value investing evaluation. So if you're new to this channel, don't forget to click the subscribe and to hit the bell notification down below and to follow up on my channel. Now let's go. As you can see right now, this is the 7 Luna Caladaman, but it's really quiet right now. I'm heading up to McDonald's to have my lunch, and we'll talk about a review about McDonald's Corporation. I'm currently ordering a Big Mac right now. Do you know that the Big Mac is used as a Big Mac index to indicate the purchasing power parity of each and every country? This is used as a form of how much is the cost of living of each and every country indication. As you can see here, this is the standard size that's available in Malaysia. So this is how big is a Big Mac in Malaysia. Now I'm done with my meal, let's talk about McDonald's. A little bit of a disclaimer here, this is not a recommendation to buy or sell. Please do your research before investing. The current PE ratio is at 26, which is considered to be a little bit on the overvalued side. Earning per share is at $7 per annum, which is considered to be on a positive side, which is a good thing. While dividend yield is at $4 per annum, which is considered to be on the average side. If you calculate, it's roughly about 1 to 2% per annum, which is considered to be a low dividend yield. The only thing that I don't really like about McDonald's in terms of their shares is because of their negative book value. A negative book value indicates that the liabilities is greater than their asset. If you want to know more about the liabilities and asset, click on my lightning lesson just to indicate what is that all about. The debt to equity ratio is about 120%, which is considered to be an over leveraged share. So in my recommendation and in my opinion, I would not want to buy, I'll just keep it whole on this share. As you can see now that the bookstore is really quiet right now and there's not many people around. That is because of the e-commerce of Amazon. So this is the book that I'm actually looking right now. This is about the Bezos letter, which is the 14 principles to grow your business like Amazon. Alright, let's talk about Amazon. Amazon currently at the EPS of 22 per share, which is considered to be a very outstanding amount. PE ratio is at 84, which is considered to be overvalued. However, the case is a little bit different. The PE ratio here is indicating that this is a growth value share because of the high amount of growth in the e-commerce sector. For the price to book value, the price to book value is around 12, which is a little bit on the expensive side. On the debt to equity ratio side is around 74%, which is considered to be on a high leverage. However, if you take into consideration, they are able to pay off through their revenues and sooner or later their debts will be able to reduce. Look at this fine Tombo pens. These are the type of pen that you use for your bullet journals. Right, let's head on to the supermarket and let's have a look at if there's any Beyond Meat products available in the supermarket. And finally, the star of the show, Beyond Meat. Stock ticker BYND. Alright, as duty calls, I do not have enough time to go in the review on Beyond Meat during the grocery shop. Hence, I decided to do a review inside this car. So for Beyond Meat currently, the earning per share is at a negative, including the PE ratio is at a negative. However, the things are going to get in a positive review. The only positive side about Beyond Meat is that they have a below or low average of debt to equity ratio, which means that they have lesser borrowing. The reason why they have negative earning per share is because it is still a new and emerging market. So when Beyond Meat is at a positive, that will make sure it allows Beyond Meat to fly. However, I think there might be some problems with their price to book value. As of now, as of to date, out of this rate, the price to book value is a little bit on the high side. Hence, I decided not to buy on to Beyond Meat at this point of time. Overall, based on the experience which I had at the shopping mall today, I realized due to the coronavirus, everybody is fearing about their safety in the market. Hence, when they are insecure, they decided to stay at home and prefer to be at home at most of the time. Either that or they are at work and working in their offices in their safe haven. It could be that they are also staying at home at that point of time. There are several honorable mentions which I haven't mentioned in the stock market, which will be companies such as Kohl's, Gap's, Tapestry, which is also part of the shares which I'm actually about to review. Most of the retail shares are giving out a very good high dividend. However, due to the earnings that is in fear of panic due to the coronavirus, I'm expecting there might be a lowering of the earning per share, as there might be a possibility of a fall in the dividends return. As of now, I would like to say stay safe everyone.